The K-shaped economy. If you listen to the news at all, you've probably heard people discussing the K-shaped economy. So let's talk about what it is and how it's showing up in our country today. We'll also talk about some key concepts to keep in mind. So firstly, what is it? A K-shaped economy is a way of describing what happens when different groups of people or businesses recover from an economic event at very different speeds. So instead of everyone moving up and recovering together like a V shape, the economy splits and some groups recover and go up while others go down. So imagine the letter K. One line goes upward and the other goes downward. That's the idea. So a K-shaped economy is where we have robust growth, expanding wealth, and a vibrant economy for the people and businesses at the top of the K, the rich people and the businesses that serve them. While the lower leg of the K is where middle and low income earners continue to struggle and mid-tier and small businesses have a really difficult time. So how does this affect the consumer? Well, on the upper leg of the K, you've got people whose income is stable, whose savings and investments grew during COVID, and who have really benefited from rising stock and home prices these last few years. These consumers keep spending on travel, tech, restaurants, and higher end goods. On the lower leg, you've got people dealing with job instability, higher debt costs, rising rents, and wages that aren't keeping up with inflation. These are the people just trying to make ends meet and who may not have investment portfolios that have benefited from the recent stock rally. These people are cutting back, they trade down, they look for bargains and good deals, they stretch every single dollar. So you end up with two completely different consumer realities happening at one time. Right now, some economists argue that the current resilience of the US economy is masking a severe weakness among low and middle income households. Why? Because the wealthiest Americans are driving a significant amount of the spending. Some data suggests that the top 10% of earners account for nearly half of today's consumer spending. The K-shape also applies to businesses, so businesses that serve the upper part of the K usually crush it. So think luxury brands, high-end travel, tech companies, or anything tied to wealthier consumers or corporate spending. On the other hand, businesses that provide non-essential goods and services to the lower part of the K feel the pain. Mid-tier brands get squeezed and restaurants see weaker foot traffic. A K-shaped economy also creates more volatility. Data looks confusing. One week, spending looks strong. The next week, a totally different group pulls back. It's not the consumer, it's two different consumers moving in opposite directions. So here are 5 key concepts to keep in mind when thinking about a K-shaped economy. So number 1, pricing power is golden. Companies that can raise prices without losing customers are usually operating on the upper side of the K. They have stronger balance sheets and loyal, wealthy consumers. So think luxury brands. Number 2, the middle class and lower class often begin to trade down. So when times get tough, people who are feeling the squeeze switch from mid-priced brands to cheaper alternatives. That's why discount stores like Walmart or Dollar General often outperform in times like these, when mid and lower income consumers feel strapped for cash. Number 3, company fundamentals matter. In a K-shaped environment, weaker companies can get wiped out very quickly. But companies with strong cash flow, low debt, and products people have to buy, not just want to buy, often have staying power. So think consumer staples, healthcare, and other defensive sectors. Number 4, there are often winners of structural change. So tech, automation, and now AI may expand during these periods. They're part of the upper leg of the K because they benefit from innovation and higher margin customers. Number 5, in a K-shaped economy, pain or strength may not be universal. So when you see data that suggests the economy is either booming or collapsing, dig in and really look at the details of the data because both can be true at the same time, and this is really important to remember. So what could flatten the K or even reverse it? 2 potential things to think about. So number 1, the labor market. We just saw the highest number of jobs cut in the month of October since 2003, according to the Challenger report. If the labor markets weaken further, low and middle income families will be forced to cut back on their spending even more. Since they make up the majority of the population, that could eventually drag the entire economy down, including higher income Americans. Number 2, the stock market. The prosperity of the upper class is highly tied to the stock market. So if we were to see a big sell-off similar to the drop we saw in 2022, the gap between the two, the top and the bottom, would temporarily narrow. However, with less government stimulus and higher interest rates today, a severe sell-off could have a much more painful economic impact than it did 2 years ago. So bottom line, a K-shaped economy is really a story of divergence, two different economic realities moving in opposite directions. To navigate it, think about which companies are well positioned for the current environment, and above all, appreciate quality and pay attention to where the money is actually flowing.